Welcome to the Deep Dive. Today, we're really digging into the information technology services sector. We've got three stocks from a recent screener, APLD, FI, and FIS, and wow, they tell completely different stories. Hypergrowth, sudden collapse, and a slow decline.
Exactly. It's a fascinating contrast. We're looking at three U.S. companies here. You've got the big players, Fiserv and Fidelity National, both over a $30 billion market cap. And then there's Applied Digital, much smaller at around $9.6 billion, but incredibly volatile.
So our plan is to give you that expert journalistic breakdown, fundamentals, technicals, news, valuation.
Right, and we'll wrap each one up with a little paper money exercise. See what $5,000 might have done recently. Now, just quickly, got to say, everything we're discussing today is purely for informational, educational purposes based on the sources we reviewed. Definitely not investment advice.
Understood. Okay, let's kick off with the one grabbing all the headlines, feels like. Applied Digital, APLD. They're in IT services, but really focused now on data center hosting and high-performance computing for AI. Big pivot.
It is the AI infrastructure play right now, it seems. And you see it immediately in the fundamentals. I mean, look, the trailing EPS is negative $1.14.
Negative. So PE is just NA then.
Exactly. And the profit margin, minus 113%.
Whoa, hang on. A $9.5 billion company with a negative 113% profit margin. That's pure growth expectation, right? Like venture capital territory almost.
You nailed it. It's all about the future potential. That's why the price-to-sales ratio, the PS, is, well, it's sky high at nearly 44.
44. Okay. Investors are clearly pricing in enormous future sales.
They absolutely are. And it all comes down to one really big piece of news that's driving this.
That huge AI pivot, you mean, the big contract.
Precisely. That $5 billion 15-year AI factory lease they announced with CoreWeave. CoreWeave is an investment-grade U.S. hyperscaler. That deal is the main catalyst. It just completely changed the narrative for APLD.
And you definitely see it in the stock chart. The technicals are just wild.
Wild is putting it mildly. Year to date, the stock's up over 350%.
350.
Yep. And if you go back to his 52-week low, which is around $3.30, it's up almost 940%.
Unbelievable. But that comes with risk, right? What's the beta on this?
Extremely high, 6.58. So it moves, more than 6 times as much as the overall market on average. Big swings.
So technically speaking, what keeps a stock like this going up? What's the buy signal or trigger?
Well, it's basically a momentum play right now. The strong buy trigger is just continued momentum. It's trading way, way above its short, medium, and long-term moving averages. SMA 20, SMA 50, SMA 200, it's well above all of them. And that CoreWeave news provides the fundamental underpinning for that momentum.
Okay, but where's the danger zone, the sell trigger?
The risk is that it's run up so fast, it hit a high of about $40.20. Right now, it's around $34.42, so only about 14% off that peak. A failure to break through that $40 level or, just significant profit taking could easily trigger a sharp pullback. That's your sell trigger watch point.
And the shorts are involved too.
Oh, yeah. Big time. The short float is almost 34%. That means a huge number of shares are betting against it, which adds another layer of volatility. Potential for short squeezes.
Okay, let's do the paper money bit. That recent performance is huge. Say you invested $5,000 3 months ago. The stock's up about 162% in that quarter.
Right. So 3 months ago, the price would have been roughly, around $13.14 a share.
So $5,000 divided by $13.14 gets you about 380 shares.
Approximately, yeah. 380 shares. Now, at today's price of $34.42, those 380 shares are worth just over $13,000, $13,079.60 to be more precise.
Wow. So the paper profit on that $5,000 is $8,079.60.
A gain of 161.6% in just 3 months. Phenomenal return.
But definitely requires a strong stomach, given that beta. Okay, so APLD is the rocket ship. Now let's slam on the brakes and look at the opposite end. Fiserv, ticker FI, market collapse territory.
Yeah, quite the shift. Fiserv, a huge name in fintech, financial services tech. Nearly a $40 billion market cap, or at least it was.
Before the news hit. Looking back, the valuation seemed okay, didn't it? PC around 11-12, forward PE even lower, like 6.6.
Deceptively cheap, exactly. The PEG ratio was just over 1.
Yeah.
Looked reasonable, but clearly something was brewing under the surface.
And then boom, the Q3 earnings report.
A total disaster. They missed estimates. Revenues actually declined 6% year over year, which is bad for a tech company.
And the big one, the new CEO pulled guidance.
Pulled it completely, no forecast for the future. That's just a massive vote of no confidence from leadership.
And the market reaction was brutal.
Instantaneous and severe. The The stock lost, what was it, $30 billion in market value in a single day?
30 billion, ouch. And analysts just piled on, right? Downgrades everywhere.
Yep, Wolfe, William Blair, BTIG, multiple downgrades came flooding in right after.
So technically, this is just a complete breakdown.
Oh, absolutely. The stock fell 44% in one day. Volume was insane. Relative volume over 23 times normal. Everyone was rushing for the exits.
It must be trading way below its moving averages now.
Way below. It's nearly 60% below its 200-day moving average. There was a massive gap down on the chart when it opened after the news.
So the sell trigger here was basically the news itself.
Pretty much confirmed by the news, yeah. The terrible earnings, the pulled guidance that fundamentally breaks the investment case for many, the technical breakdown just confirmed the selling pressure.
Is there any technical argument the other way? Anything for contrarians?
Well, yes, potentially. Because the sell-off was so extreme, the RSI, the Relative Strength Index, plunged to about 13.
13, that's deep in oversold territory, isn't it? Usually below 30 is considered oversold.
Extremely oversold. So while the fundamentals look really damaged right now, technical traders might see that RSI reading and look for a potential short-term bounce, a relief rally. But the underlying problems remain.
Okay, the paper money scenario here is going to hurt. Let's say you bought $5,000 worth right before the earnings disaster. The price was $126.17.
All right, $5,000 at $126.17. That gets you around 39 shares.
And after the collapse, the stock closed at $70.60.
Oof. So those 39 shares are now worth only $2,753.40.
Meaning a paper loss of $2,246.60?
That's right, almost $2,250 gone. A 44.9% loss pretty much overnight.
Sobering. Shows that size doesn't guarantee safety at all. Okay, so we've had the rocket ship and the implosion. Let's look at our third one, Fidelity National Information Services, FIS. This seems more like a slow, grinding decline.
Yeah, FIS is another big player, financial tech solutions, about $32 billion market cap. The valuation story here is kind of confusing.
How so?
Well, the trailing PE is really high, like 230, but the forward PE looking ahead is much more reasonable at under 10, around 9.8.
So the market expects earnings to recover significantly from where they are now.
Exactly. It's pricing in a big improvement. But the current performance is just okay. Profit margin is low, only 1.55%. Sales growth was about 5% quarter over quarter.
They pay a dividend, though, right? About 2.7%.
They do, but the payout ratio is over 100%, which means they're paying out more dividends than they're currently earning. That's not sustainable long-term unless earnings pick up.
And ownership is mostly big institutions.
Extremely high. Over 100% institutional ownership, which can sometimes mean index funds and passive holders are locked in.
What's the news backdrop for FIS? Are they just sitting still?
No, they're definitely trying to make moves. It feels like a company in a major transition. They've made acquisitions like buying amount for digital account opening, and they're partnering with Circle, the stablecoin issuer, to bring that functionality to banks, trying to modernize.
But these things take time, I guess.
A lot of time. They have a big divestiture, the issuer solutions business, but the regulatory review isn't expected to close until maybe the first half of 2026. So this is a multi-year story.
Any signs of life? I saw something about insider buying.
Yeah, it's minor, but one director, Jeffrey Goldstein, has been buying some shares over the last few months. It's not huge amounts, but it's interesting to see some insider confidence against the backdrop of the falling stock price.
Speaking of the falling price, what's the technical picture look like?
It's not pretty. It's been a steady downtrend for months, down over 22% just this past quarter, and down nearly 24% year to date.
Where is it relative to key levels?
Crucially, it just closed at $61.50, which is actually below its 52-week low of $63.
Uh-oh. Breaking the 52-week low is usually a bad sign, isn't it?
It's often seen as a critical breakdown point, yeah. That's a definite sell trigger for technical traders. It suggests the downward momentum is strong and could continue. It's also trading below its near-term moving averages, the 20-day and 50-day.
Any glimmer of hope, technically, like with Fiserv's RSI?
A little bit. The RSI is around 28.5, so it's getting close to that oversold territory again.
Right.
So you combine that oversold reading with the strategic moves they're trying to make and that insider buying. You can see some technical traders or value investors starting to sniff around. That's your watch for a turnaround signal. They might be looking for a bounce if they believe the long-term plan can work.
Okay, last paper money simulation. A $5,000 investment 3 months ago, reflecting that 22.5% quarterly loss. What was the price back then?
Let's estimate. Probably around $79.40 per share 3 months ago.
Okay, $5,000 divided by $79.40, about 63 shares.
Sounds right. 63 shares at the current price of $61.50.
Those shares are worth $3,874.50.
Correct. So that's an estimated paper loss of $11,125.50.
A 22.5% loss over the quarter. Not as dramatic as Fiserv, but still a steady erosion of capital. Man, what a spectrum within just one sector. APLD, the AI rocket, delivering huge paper gains thanks to that CoreWeave deal. Then Fiserv, just a shocking overnight implosion on bad earnings. And FIS, this slow, painful bleed while they try to transition.
It really highlights a key lesson, I think. For you listening, the big takeaway is that in IT services right now, market cap size offers zero protection. You've got this extreme volatility everywhere. High beta winners like APLD making fortunes, and then these massive established companies like Fiserv seeing value absolutely destroyed when they stumble fundamentally.
It feels like the whole sector is under pressure to adapt to AI, digital banking, stablecoins.
Definitely. The old models are being challenged hard.
Which leaves us with a provocative thought, maybe. Seeing how fast and how brutally Fiserv collapsed after its missteps, how quickly can these other huge legacy financial service tech firms like FIS really pivot? Can they change fast enough to compete with the new demands?
And, maybe more importantly, how much hidden risk is still potentially lurking in the valuations of these traditional players, still going through these long, painful transitions?
Something to definitely keep an eye on. That's all the time we have for this deep dive. Thanks for joining us.